Today, we're going to pull back the curtain on the brands you use every single day because it turns out your morning coffee run and your late night shopping spree are all part of this massive, kind of hidden financial system. So let's get into how it all works.
Let's just start with this number, $1.87 billion. Any ideas what that is? Well, it's not sales, it's not profit. That is the amount of your money that Starbucks was holding as of its Q2 report in 2024. Yeah, that's just customer cash sitting on their balance sheet. Which, leads us to the big question we're going to tackle in this explainer. How on earth is a company that sells Frappuccinos operating like one of the largest financial institutions in the entire country? To figure that out, we've got to first understand the mechanics of what I'm calling the coffee shop bank. And believe me, this isn't some accident. It is a brilliantly designed financial machine hiding in plain sight.
To really put that $1.87 billion in perspective, if Starbucks was an actual official bank, its customer deposits would make it one of the top 10% largest banks in the US. That's right, it's holding more of our cash than 90% of the actual regulated banks in America. It's wild. So what's the official kind of boring accounting name for this mountain of cash? It's called a stored value card liability. But what that really means is this. When you load money onto your Starbucks app or gift card, you are literally giving the company an interest-free loan. They don't owe you cash back. They just owe you coffee. And in the meantime, they get to use your money to run their business.
Okay, so how does this whole thing turn into a profit machine? I mean, holding your money is one thing, but actually turning it into pure profit without selling a single extra cup of coffee, that's where the real genius is. This slide breaks down the money loop perfectly. It all starts with you, step 1, loading money onto your card. Then, in step 2, while that cash is just sitting there, Starbucks gets to use it. That's a financial term called float. It's basically a giant free loan from all of us. But the real magic trick for them is step 3. You forget about the last dollar or two on your card. We've all done it. Well, that forgotten money has a name too. It's called breakage. And in step 4, Starbucks gets to just take it. They claim it as pure revenue. And how much does all that breakage add up to? Get this. In 2024 alone, Starbucks reported a mind-blowing $207 million in revenue just from money that people put on cards and never ever spent. That's pure profit from nothing. This quote really just nails it. Starbucks isn't a coffee chain with a cool app, it's a consumer wallet with a retail front end. They didn't just make ordering easier, they built a fintech product, wrapped a coffee shop around it, and created a financial powerhouse. Okay, so that's how brands get you to give them a loan. But what happens when we flip that script completely? Well, that brings us to the other side of the retail finance coin, the buy now, pay later model, where the brand or one of its partners gives you an instant loan right there at the checkout. So let's talk about this second major trend that's reshaping everything, the absolutely explosive rise of these instant loans. This model is fundamentally changing the way we shop, especially online. So what exactly is Buy Now, Pay Later, or BNPL? Well, it's pretty much what it sounds like. It's that super seamless option to split a purchase into smaller chunks over time, and a lot of the time, there's no interest. For younger shoppers especially, it's become this go-to alternative to credit cards because it offers flexibility and you get your stuff right away. And just look at the growth here. I mean, the global BNPL market is set to blow past $500 billion in 2025 and is rocketing toward almost $1 trillion by 2030. This isn't some little trend. This is quickly becoming a core part of how we all shop. But you knew there was a catch, right? This incredible convenience, this frictionless way to get credit, it comes with some pretty serious hidden risks. And, well, regulators are definitely starting to pay attention. The very things that make BNPL so attractive are also its biggest dangers. It makes impulse buys way too easy, and it's not hard to start juggling multiple small loans at once, which can lead to serious debt. Research shows that users often have riskier credit profiles to begin with. You miss a payment, and suddenly you're facing late fees and a potential hit to your credit score, all because the system removes that pain of paying, making it really tough to judge what you can truly afford. This quote from Germany's financial regulator, BaFin, really hits the nail on the head. Without those traditional credit checks, it is solely up to the consumer to judge if they can handle the payments. It puts the entire burden of responsibility on shoppers who, let's be honest, might be using BNPL in the first place because money is tight. So because of all these risks, the whole landscape is shifting.
Regulators across the globe are now stepping in to try and write some new rules for this weird new world where retail and finance have merged.
Let's just take the UK as a perfect example. Their Financial Conduct Authority is rolling out brand new rules. By the middle of 2026, all BNPL lenders are going to need official authorization. And the really big change coming, those robust affordability checks, the very thing regulators say is missing, are going to become mandatory.
Now, the ultimate goal here isn't to kill off this new type of payment. It's really to find a critical balance, protecting us, the consumers, from getting into huge trouble, while still allowing for the kind of financial innovation that makes these services so popular in the first place. Okay, so let's tie this all together. This is the new retail playbook. Step 1, a brand holds your money up front, just like Starbucks does. Step 2, a brand finances your purchase for you, like with BNPL. When you combine those two models, you create this incredibly powerful financial ecosystem. And what's the end goal? It's to lock you in as a customer and make money in ways that go far beyond just selling you products.
Which leaves us with one final, pretty important question to think about. As these lines between shopping and banking just keep getting blurrier, and every brand is trying to manage a piece of your financial life, who really holds the power? Is it you, or is it them?